was a really interesting end to the week because we basically almost completely erased what happened in the first 4 days of the week.
We did. So from Thursday morning, especially through the end of Friday, obviously, I think economic sentiment just got too sour, and then it wasn't prepared for a roughly on-target couple of reports. I think the question today is, are we going to see that sort of late Friday levitation challenge a little bit? And I think that's a very modest move this morning so far in the futures. Treasury yields up slightly, but not really budging much off their lows. So I do think we're still in that same game of figuring out exactly how negative people got in terms of leaning toward negative news for the economy and whether that was true, whether that really holds true. Trade deal, I don't think anything great is priced in, but I think the street has kind of quit handicapping it on a short-term basis.
Right. Stephen, where do you stand overall in your portfolio allocation? You're underweight now bonds,
yes,
but you're moving away from defensive. So what does that mean?
So we spent about a month and a half going from overweight fixed income, underweight equities, back in the direction of a more risk-taking profile. Now, at the moment, we're at neutral in equities. We have an overweight in gold, a little bit of overweight in cash. But the issue is we got global bond yields down to all-time record lows, 1.5%, including emerging markets, including high-yield bonds. And I think that what we've seen out of the data, as Mike just said, below consensus data through the week. This will be the weakest quarterly earnings season that we have of the year, but we haven't broken the expansion completely. And the ability to come back from it in 2020, I think, is a little bit under-recognized. And so I think the good chance here that we have mild gains, not 11% consensus EPS, you might as well say up 111, but the ability to hold this together, to absorb this industrial recession around the world, and have it just outlast and recover in 2020. I think the prospect of that is reasonable, and relative valuations are telling us that we can do this now.
So when you say you're moving away from defensives, which sectors did you move away from, and which did you put a little bit more money towards?
Well, for example, a little down a bit in staples, a little bit up in discretionary. Cyclical industries in general, companies that are able to increase dividends, that pay well above bond yields and are not bond equivalents, that are not utilities trading at tech stock style valuations. But those that consistently raise dividends look fabulous relative to this bond market.
Yeah.
And in the U.S. bond market, again, we still have an overweight, but globally we're underweight. And even in the United States, these are going to be relatively stretched bond valuations at a certain point.
In terms of what happened last week, Mike, I thought it was interesting that, we had this powerful value trade going on. And by the end of the week, it was clear that, for instance, banks, which had benefited tremendously from that value trade, they still were just, at the mercy of yields. So,
they were. Oh, Friday perked up a little bit. You've had this kind of steepening of the yield curve in a way that you don't necessarily want, but short-term yields going down more. But, I think right now I have to be agnostic as to whether we saw a real style shift. It was a real dramatic repositioning toward value, but it has not really been something that's carried through. I think the large growth stocks, it's hard to see a scenario where the overall market really performs well and kind of gets back toward its highs, and it's just on the back of, energy, financials, and beaten down retail and auto stocks. It just doesn't really work that way.
Mathematically, it can't really work that way.
Mathematically, it doesn't work that way. It just doesn't seem like we're at that part of the cycle for that.
Yeah.
Well, look, shares are up 2% from this time a year ago. Bond returns have been, last I checked, 11% higher than a year ago. This has not been a marketplace where we have had a deep undershoot. It's not 2016. It's not the fourth quarter of 2018, where we clearly had tremendous opportunity to see a rally and be far overweight in equities, expect 20% type rebounds. It's not like that. It's very frustrating, in fact, that markets appear roughly in line with this fundamental story where the base case is we eke out some gains. That's why, again, we're focusing in on quality, on higher bond ratings, the ability to pay a rising income, tangible returns now. Again, it's not to say that we won't get some improvement. Again, it's some of the beaten down, IT names that always come back if their fundamentals are intact. But this is really a time, again, for us to, shift gradually. And in this case, I think a little less defensive because the consensus has gone very remarkably defensive.